Sarbanes-Oxley changed the standard for accountability. And in the age of AI, that accountability is becoming even more personal. Section 404 is about internal control over financial reporting. It requires management to take responsibility for the control structure and assess whether those controls are effective. Section 404 also links to auditor attestation requirements for applicable issuers. Section 304 raises the stakes even further. If a company must restate due to misconduct, the CEO and CFO can be required to reimburse certain bonuses, incentive compensation, equity-based compensation, and profits from stock sales tied to the relevant period. SEC actions also make clear that this reimbursement can be required even where the CEO or CFO is not personally charged with misconduct, and quarterly reporting carries its own burden. Under Section 302 and the SEC's rules, CEOs and CFOs certify the quarterly report, are responsible for disclosure controls and procedures and internal control over financial reporting, and must disclose significant deficiencies, material weaknesses, and fraud involving people with significant control roles to the auditors and audit committee. That means the quarterly Form 10-Q is never just a finance event. It is an enterprise accountability event. Legal supports precision in disclosures. Finance supports reconciliations, estimates, close quality, and control evidence. Information technology supports access, change management, system integrity, cybersecurity, and data reliability. Procurement supports third-party risk, vendor obligations, and contractual controls. Internal audit and control owners support testing, remediation, and escalation. And now AI changes the risk profile. If AI is used in drafting disclosures, summarizing contracts that affect accruals, supporting forecasts, generating close support, assisting journal entry review, or shaping management analysis, then AI is touching disclosure controls and potentially internal control over financial reporting. That is an inference from the SEC's Disclosure Control Framework and Section 404 control responsibilities. So the question is no longer whether AI is innovative. The question is whether AI is governed. Who owns the tool? Who validated its output? What data is it using? What changes are monitored? What evidence is retained? What happens when the output is wrong? Who escalates the exception before it reaches the filing? Those are not technical questions alone. Those are CEO and CFO certification questions. And every employee who touches the reporting chain has a role in the answer. Employees support successful quarterly SEC reporting by following controls, documenting work, preserving evidence, challenging anomalies, escalating deficiencies early, disclosing errors, and refusing to treat AI output as self-proving. The SEC's certification framework specifically ties officer certifications to disclosure controls, internal control issues, and fraud escalation. In the end, trust in reporting is built long before the filing date. It is built in the workflow, in the evidence, in the escalation, in the discipline. SOX 304 is the consequence. SOX 404 is the control expectation. And AI enterprise governance is now part of whether the company can meet both. If AI touches reporting, AI must be governed like reporting. That is how companies protect the filing, support the CEO and CFO, and earn the market's trust.